Awesome. Thank you everyone so much for being here. Some incredible faces in the room and a couple dozen folks online too, so we have a great turnout for this. On behalf of Startup Boston, I'm Emily and our partners M&T Bank. We want to thank you so much for being here, for taking the time out of the evening, especially on this gorgeous day, to be here and to learn about financing your startup. Startup Boston has the opportunity to host events like this throughout the year that really bring the startup ecosystem in Boston together and give us the opportunity to learn from one another and to inspire one another. We bring together founders, investors, and really everyone in the community, but we wouldn't be able to do that without our fantastic partners. So with that, I will turn it over to M&T, to David, to say a few words.
Thank you, Emily, and good afternoon, everybody in the room. Thanks for joining us, as well as the virtual participants who are here tonight. My name is David LaPergola. I'm the Retail Regional Manager for M&T Bank, covering the branch network outside of Boston. So any branch you see, probably part of my territory, and been helping with the integration work as we had recently acquired People's United and really want to make an impact in the local communities that we're in. You might be asking, who is M&T Bank, or what does it stand for? It's probably the most common question I hear. So for those of you who are not familiar with us, M&T is Manufacturers and Traders Bank, based out of Buffalo, but have a regional headquarters here in Boston, as well in the Belmont community, just locally. For us, it's really about building partnership. And I heard a little bit about Emily's introduction with Startup Boston. And when I moved here as part of this acquisition in September, it was Startup Week. So ironically, it was great timing to first see Startup Boston in action. And at the time, I knew right away that M&T wanted to be a part of this. Some of the core principles that the organization has to help the startup community, whether you're thinking of an idea or you're in the infancy stages of your business, or you're somebody who's been well established and has grown throughout partnership with Startup Boston, I knew it was something we could do. With M&T, on my side, it's I'm on the retail side. However, a lot of what we do in the retail branches is help small businesses get started. Building relationships with your bank is super important. Finding the best source of funding to help your business take that next step, whether it's the startup phase or maybe an expansion. That's really what we do best. And it's all about knowing our customers. And similar to what we'll talk about today, and the panelists will go into different details around financing your startup. This is a great opportunity for us just to continue partnering with organizations like Startup Boston to help the local communities that we serve. So with that, pass it back to Emily, but good seeing you all, and I hope you can hang around for a few minutes after the presentation. Love to get to know as many as I can.
Thanks, David. So if you know Startup Boston, you know this, and if you're new to us, you're hearing it and you're seeing it now. It's all about partnership, it's all about community, and that's why we're here. And I would be remiss if I didn't give a huge shout out and thank you to the CIC, which is the wonderful space that we're in here now. So thank you, CIC, all around. It's a wonderful space. Awesome. And with that, we're going to learn about financing your startup. JP, I'll let you take it off.
All right. Thank you very much, Emily. So welcome, everybody. Hope you got to enjoy the beautiful day out there for a little bit. So here we're talking about funding, different ways of funding your startup. Talking about dilutive funding, non-dilutive, and debt funding. So what I'm going to do is I'm going to introduce the panelists. Let's start off with you, Allison.
Okay. I got it to turn on, Stephanie. Don't worry. I almost worried for a second. Okay, I was like, oh no. Hey everybody, I'm Allison Byers. I'm a two-time startup founder. My current company has a funny name. It's called Scroobius, and we're a marketplace where on one side we have a platform that educates and guides founders in how you create investable pitch material, and on the other side we use AI curation to help early stage investors discover you. So just before this, I ran a different startup. I launched a medical device company, raised about 10 million for that, have done all the different ways of funding that we're going to talk about today. And I'm also an angel investor myself.
All right, Aaliyah.
Hi everyone, my name is Aaliyah Forrest. I work at the City of Boston at the Mayor's Office of Economic Opportunity and Inclusion as the Director of Business Strategy. Our unit works with businesses of all shapes and sizes if they want to expand or locate their business in the city. I know we're across the river right now. Don't tell my boss. But if you are interested in learning about grant funding, the city, the state typically has grants available for startups and small businesses. And I'm happy to be here today to talk about how you could apply for those. Before I worked at the city, I was in the nonprofit sector for 10 years, so I'm very familiar with applying for grant funding, and I'm happy to be on the other side to give out money. So here we go. Next.
David.
Good afternoon. My name is David Graves Witherell. I am with M&T Bank. I am a business banking relationship manager. I've been in the greater Boston market for, let's say, over 20 years. And what I do is I typically spearhead the relationship between the bank and the business. That business could be early stage. We've got some ideas. We have our personal accounts with you, and we wanted to talk to you to see, does this make sense? It's something you can help us with. So I can get in very early. And I also work with our partners if you get to the point where you're looking to do an exit or maybe transition and sell your business to the next generation, to your employees, what have you. Chances are we're a big bank, we have those resources. But more importantly, our attitude, and Dave's talked about this in his introduction, we're very client focused, we're very collaborative. So although we're a big bank, you shouldn't feel that way as a customer if we're doing our job the right way. This collaborative approach that we're having today, this is really what we're all about. When Dave first came to our marketplace with the merger, he saw the startup weeks of Dave. Is this something that we should pay attention to? Absolutely, you're on the right track. This is where the energy is. This is where the action is. It's not easy. If it was easy, everyone would be trying to do this. It's not easy, but you have to have passion and you have to have the right team around you. And I think we have a lot of that in this room, and I'm looking forward to this conversation.
All right, excellent. And I am your moderator, JP Puchulu. I am the managing partner of Boston Startup CFO. We provide consultation on all types of finance, fractional CFO, bookkeeping, accounting, and such. We provide help with the 3 different types of funding that we are going to be talking about today. I am also the executive director of something called GrowthCraft. We're launching a startup community for startups. So we're going to be helping all sorts of advisors, helping in all sorts of ways, helping out startups and startup founders. Check us out at growthcraft.org. Okay, so let's jump in. So again, we're talking today about dilutive funding, non-dilutive, and debt funding. So why don't we start by just kind of talking about the different types of funding. If you could kind of give us like a high-level overview and talk about like high-level pros and cons of each. Why don't we start with you, Allison?
Sure. All right. So I'm going to talk about diluted funding today. That's my role on the panel. So diluted funding means that you are looking for equity investment. And it's dilutive because you are essentially selling part of your company to another entity. So you're diluting your ownership of your company in exchange for that money, for that capital. Now within dilutive and within each of the things we're going to talk about today, there are different ways that you can capitalize even within that. So with diluted funding or equity investment, there's very different types of investors that have pros and cons to them as well. So we all know venture investment. Everyone talks about venture capital, and that is one avenue. That's one type of investor that we'll talk more about today. There are other types of equity investors. So there's also angel investors, which are very different in what they look to invest in and what they need out of an investment than a venture fund would be. There's family offices, which operate somewhere in the middle of an angel investor and a venture capitalist in terms of what they're looking for and their needs. And there's even other pathways beyond that. But we'll focus probably on those. And for early stage investment, angel investors are a really great pathway. So one thing I'll just set up between venture capitalists and angel investment, because it's really important to understand the underlying dynamic. When you think about, is equity investment right for me? They're very different in how the underlying mechanics work. So with the venture fund, these general partners or GPs of a venture fund are managing other people's money. That's really the key difference to know. They have limited partners of their own, or LPs, and they are taking that money and investing it on their behalf. This results in different needs and motivations, right? Because they have to report back to those LPs. They have to defend the investments that they make and show that it is what they told the LPs they would be investing in. They have to show their returns, and they need big returns because they have to have a portfolio approach, and they have different commitments they're trying to live up to on their end. An angel investor or a family office or other types of investors that are not managing other people's money, it's just their own discretionary income, right? So I'm an angel investor, and there's different pathways that we take. We can invest directly, so you might meet an angel investor and have a great conversation and they're interested in investing. They may be part of an angel group. In Boston, we have a lot of angel groups. I'm part of an angel group. They might run a syndicate and it's almost like they have their own little LPs, but it's still not a fund. It's not a fund structure, it's people's individual money. And so we'll talk more as the panel goes on, and I'm happy, we'll have time for questions because I know there's a lot to unpack there. But in all of those cases, you are looking for somebody to give you money in exchange for owning part of your company. And the big thing there to think about when you're comparing what is the right funding strategy for me is the only way an investor who owns part of your company gets a return is if you have an exit event, right? So you enter this cycle of either needing more funding rounds or something else happens, there's another financial transaction that increases the value of the shares that you sold them in your company, or you exit, you have an acquisition, you get purchased, or you IPO, or you somehow exit your company and you return a higher value than where those investors bought the shares at. So you're working toward that exit. As a startup founder, you may or may not want that, right? Which is why it's so important to consider every avenue of funding, of capitalizing your business. You might not want to work toward an exit that happens in the next 5 to 10 years. If you don't, you probably want to think twice about seeking equity investment because you'll have a misalignment with your investors. So I think I'll probably leave it there. There's more to talk about, right?
A lot more.
Yeah, but I'm wary of our time, and I want to make sure
Yeah, we'll
I'm not
definitely get
taking
back to
too
it.
long. But the other thing maybe we'll return to is even within that, there's different ways to accept that money. So there's different vehicles, and you might have heard of some of these terms, like a convertible note or a safe or a priced round. Those all have different implications as well, with lots of questions that go along with it. So we'll return to it. But I think the overall, message here with dilutive funding is you have to want to exit your company at some point, where it's not the right path. And then there's a lot of different things to consider about how you structure taking that money in based on the stage of your company.
Perfect.
All right. Yeah, please.
That was very interesting. Yes.
Very nice overview.
Yes. So as I said, I work for city government, and I'm going to talk about grant funding. What's interesting about grant funding at the city and state level is it didn't really exist before COVID for small businesses and startups and entrepreneurs. I think, I don't want to say that good things came out of the pandemic, but the one good thing that did was, I think, that the city and the state both realized how much the business community is the lifeblood of our society and how much we need to keep our businesses afloat. So during the COVID-19 pandemic, there were a lot of business grants out there, the PPP, the EIDL at the federal level, and even the city gave out millions of dollars to small businesses. So now we're in a phase where the city has a whole grant template, timeline, and an opportunity for us to give more grants out to businesses looking to open in Boston, specifically small businesses, so under 25 people employed at the business, startups as well, if it's fitting in within that category. And specifically, the last time I talked with folks at a Startup Boston event was about a program called the Space Grant Program, where our goal is to fill vacant storefronts in a downtown area because there are so many vacancies on the storefront level. So if you do see a grant opportunity, it's usually connected to a policy or program that that's for a public purpose. So you're not going to see grant funding out there just because. You're going to see grant funding out there because there's a mission-based public purpose around that grant. So I would say the pros of a grant is you don't have to pay it back, and it's usually one big bulk sum, and it is for a specific project, usually project specific. So for example, for the Space Grant Program, we offered up to $200,000 for startups and young entrepreneurs, young meaning it's a company that hasn't been around for a long time, to fill a vacant storefront. And the money can be used for operating costs and build out. But reading the small print, you can't pay yourself, you can't pay for products. And I would say the cons is to, when you're looking at a grant application, to read the eligibility requirements. These applications are typically daunting. They're very long. They ask for a lot of, what is your profit and loss in the last year? All kinds of documents that are needed to be uploaded to the form. And if you are not reading the eligibility requirements of all these city and state grants, and you fill out that really, really long form, and then you're told, actually, you are not eligible. So I would say read the application fully. A con on our part is I don't think these are publicized very much. So you do have to dig deep into city and state government websites, be like, what grants are available right now? So my advice to anyone who's looking for grant funding is to sign up for any newsletter that you see on a city business development website, wherever you live. In Boston, there's a small business development website, and we share all kinds of resources, not just grant funding, but technical assistance for businesses of all sizes. So I would say read, apply, and ask questions.
Free money is not free. So you got to do your research, take some time, but well worth it. David.
Okay, so on the debt side, for bank, I'm gonna break it down. There's your personal debt, so your credit cards, maybe a home equity line. So there's that type of financing for a bank where basically you're borrowing from the bank yourself personally, and you're investing in your business. So that's really gonna be shown as equity on your balance sheet. And then later on, when business can stand on its own and has positive operational cash flow, you get to refinance it and pay yourself back and put it back as business debt, not personal debt. What I'm really going to focus on though is on debt to the business. So the way we get paid back is you pay us a loan by running a successful business, you're profitable, the operating cash flow generates enough extra cash that you can pay us back. We don't want you to sell your business to get paid back. We don't want you to have to, if maybe you're using your money to buy your location for your business, we don't want you to sell that location to pay us back. We want you to run a successful business. So we're a little on the conservative side, but our money is cheap that way. Some people will say, gee, banks won't lend to startups. Not necessarily true. Again, it really depends on who you're talking to, where you're at in your business plan. and a whole bunch of other factors. And there's really no generalizations like that. Banks will use some tools like the SBA guarantee program to help say yes, where otherwise banks would have a hard time. It will allow us to use projections in terms of your income. It'll allow us to overcome a collateral shortfall for lending as well. So there's a variety of ways we can work with early stage companies, whether it's on the personal side or the business side. But again, our money is cheap because we're on a conservative side. That's good. But if your bank won't lend to you or no bank will lend to you, that doesn't mean that the bank that you're with is not important. There's a lot of other ways a good bank should be able to help you and support you from the early stages and as you grow. So that's another thing I want to make sure I mention right in the beginning is if your bank says no, that doesn't mean they're a bad bank. You definitely want to shop around because, again, we all have different appetites for different companies. But if you can't borrow money from your bank, that doesn't mean that where you bank is not important. Because as things start to accelerate, as you start to grow, things happen real fast. That's not the time where you want to know, am I working with the right bank? Do they know who I am? Can they support me? What if I want to borrow now? Am I with the right bank or do I have to change? Because changing banks can be rather disruptive, especially if it's not your choice to change, but you have to because I need money and this bank will give it to me, this bank won't, so I got to move everything over. You want to do your homework ahead of time.
Excellent. Thank you, David. All right, so let's dig in a little deeper now. Let's talk about, are there any unique advantages that you could think of to share that startup founders might not be aware of? Allison, please.
Okay.
Thank you, Allison.
Sure. So with equity investment, one of the biggest advantages is when you have an investor, they are not just financially, but personally invested in having your company succeed, right? They put money into your business, into you, and they won't see it back if you don't succeed, let alone a profit, right? They won't even break even on that money. So they want to help you, right? They're along with you for the ride. They bring resources, so they bring human capital, they bring social capital, they will help you in a number of ways. And this goes for any of the types that I talked about, right? Whether it's venture or angel or family office or crowdfunding is another option. Those investors, you can call on them. They can sometimes serve as a sales channel for you or a distribution channel based on what your business is and who you've brought along. They can introduce you to partners and suppliers and other investors, and that is a huge advantage to having them along. But when we talk about different types of money being more expensive or less expensive than others, right? In the case of equity, well, it's expensive because they own part of your company. So when you do have an exit, right, they get some of that. You don't own 100%, but you don't have to pay it back, right? Like a loan, or you don't have to go through lengthy applications and waiting windows, right? Like we applied for a grant at my company. It's been, I think, 4 months, and I don't know when I'm going to hear back, right? That's one of the things that happens with grant funding. Equity investment tends to be a lot faster than that. So that's a big pro. Are we talking about cons too, or just pros?
Well, it's more of like any advantages right now.
Okay.
They might not be aware of. So, yeah.
So that would be a big advantage. Another big advantage is you get the money pretty quickly, especially if you do what's called a SAFE, which is an agreement for future equity. Again, I'm happy to go more in depth based on what everybody here, if you have questions about the differences between a note or a SAFE. There are differences, but with the SAFE, they sign the agreement after you make sure that they are accredited and able to invest in you, and they wire the money, and it can happen pretty quickly. So that's another big advantage. But I think the strongest one for me is the social and human capital that comes along with who you choose to have as an investor in your company.
Difficult decision, and as they say, be careful of who you pick as your investor. Some startups might think, okay, I'm hoping that I can get an investor, but no, you want to be very careful of what investor you bring on. Aaliyah?
I'm so glad you talked about the timeline of getting your grant. Any city grant funding takes a while. I won't go into detail about the space grant program, but anytime we hear like, hey, who are the awardees? When am I getting my money? And I'm like, there are layers of approval that any city funding going out has to go through. So that is definitely something to think about if you are applying for a grant. Is if you need it immediately, like tomorrow, it's not going to happen. It's going to be a while. But advantages is if you are part of any city or state program that's supporting your business, if that's money, if that's business support, technical assistance, if you show that on your business plan or paperwork when you're looking for space, when you're talking to a landlord, when you're talking to a bank, it shows, oh, the city supported this business or the state supported this business, and that gives you a little bit of a leg up that the mayor or the governor and their folks are on your side and they have trust in your business. They've invested in your business in some way. So why wouldn't this bank or why wouldn't this landlord? So by participating in city events, programs, and grant funding, that's something to think about as an advantage. And also, as I mentioned before, if you do participate in any city grant program, there's usually a big program project behind it, some sort of policy, and there will be a lot of press around it. So there might be a press release or a press conference, an event where you would be invited and everybody would know that you are one of the participants. So there's usually some good publicity if you do get a grant. There will be some sort of an announcement about it, and it might be in the paper, it might be on the news, and that's really great for marketing your business and your startup and what you're doing. I'm trying to think what else. I think those are two big ones.
And something else to add there is that it validates, if you get some grant, it validates what you're doing, and investors like to see early validation. So
Yes.
that might be another advantage as well, right?
Absolutely, yes, exactly.
Great. All right, David, please.
Banks like that too.
Yeah.
We do not want to be the first ones to take a risk. So if anything you can do to show, proof of concept that you've done your homework, you have a great business plan, you've identified who your target customers are, you identify how you're going to sell, what your costs are, how much you think you can realistically get, is important. If you can, support that with validation from a third party, like the city of Boston, that goes a long way. So I think as Allison, you mentioned that even with venture money, it's not all money is equal. What comes with that? The same is true with bank financing. So if the bank is doing the right thing with you, they want to, why do you need the money? What is the purpose? Not, well, how much money can I get? It's like, well, what's driving this demand? Because there's different ways of financing different needs, whether it's a line of credit for more of a short-term cash flow issue, or if you a term note to buy equipment or to buy a new location, or perhaps to buy a business. And maybe that's how you want to get into the business. You have an idea, but gee, starting off on my own is really tough. But if I buy an existing business, somebody's on their way out, I'm going to get a certain amount of bones, if you will, some structure I can work with. And then I can kind of direct it the way I think it should go and do a better job. That's a great opportunity for bank financing. Because again, you're not looking to sell it down the line necessarily, you're looking to build it and create value. So when you're looking at bank financing, you want to make sure that you define your financing need. How much do you need and why? And how are you going to pay that back? Where is that coming from? Banks are going to want to know that. You're also going to do your homework with a bank. You don't want to have a bank that says, hey, yeah, we'll lend to you. And they're really fast to write that check. They're also really fast to get impatient or get nervous and put you in a workout and make your life miserable. You want to make sure that you have a bank that's understands your line of business, where you want to go, has done it before, and is going to be there to support you. Understanding that there are cycles and there's going to be some rough times. It's going to be rough for everybody. What do you do about it? How do you handle it? How is that bank that you're talking to, how they handle it with their customers? So again, it's not just a matter of who's going to give me money, but what comes with that money or what doesn't come with that money that's important to me.
Great.
Yeah, let's dig in a little deeper there. Why don't we talk a little bit more about managing risks and talk a little bit more about like pitfalls that need to be avoided. Allison?
Yes, there are a lot of pitfalls with all of these things. With equity investment, JP, you had said it before, picking your investors is really important. As startup founders, we often consider ourselves in a place of need, like we're coming out as needing the investor. The investor needs us too. They don't make money if they don't make investments. So you're coming to this as an equal at the table, and you should have that mindset, which means you also get to be choosy. You want to have the right partner, right? You're offering shares of your company. This investor is with you. They own shares no matter what, even if you start disagreeing with each other or have different strategies that you want to pursue. So you want to make sure that you get along with the investor, whether it's a fund that you get along with the fund and the deal team and the people that work there, or whether it's an individual angel, or whether you're using something like a crowdfunding platform, that you understand those regulations and what you're going to have to report and what you owe to that platform. Because you're in it for the life of your company, right? And I've certainly been in the position of things turning sour. You don't know how your company's going to go. And if you don't have a good relationship with your investor, it can really, really cause a lot of big issues, especially if you get to a priced round. So when you do equity investment, usually at the early stages, they don't actually own any of your company yet. If you do a convertible note or a SAFE, they don't own it until a later round when it's called a priced round. That means that you've built up enough value in your company that your shares are worth enough to go get a valuation, to have a third party tell you how much a share is worth, right? You don't want to do that when you're super, super early because your shares aren't worth anything. So that's why you do a note or a SAFE. And when you get to that priced round, now they actually own the shares, and if someone owns a significant portion, or usually if it's a fund, they want to start having some governance over how you operate your company because you're using their money to make those decisions. So then you have a board of directors, and they have a real say, not just over how you run your company, but whether you should be the one to run your company. Right? They can kick out a CEO, even if you're the founder, if they have enough governance and voting rights. So you really, again, want to make sure you're bringing on the people you want to bring on because you have all the power at the early stages. So put a lot of thought into it. Don't just take money because it's being offered to you. Really think carefully about it. That's probably the biggest downfall. The other, risk area thing to pay attention to are the terms of investment. There's a lot of negotiation that can happen, and the investors usually understand those terms better than the entrepreneurs do because that's their business. There's a lot of risk that can come into a term sheet, and you want to be sure you understand it and you know what you're reading, and there aren't any tricky things in there. So that's where advisors or banking partners can help you look at term sheets or CFO services, right? There's lots of people around that can help you make sure you understand what you're reading, because there's, again, a lot of founders who've entered unfortunate situations because they signed terms they didn't truly understand, and it really hurt them later. But I think those are my biggest things to look out for.
Yeah. Along with that, very important relationship. You need to find the right attorney. I've talked to many startups that have attorneys that are kind of dabbling. They know the space a little bit. Be very careful. Your attorney needs to have a lot of experience and the patience to walk you through it all. All that's very important. Yeah, please.
Everything you're mentioning right now reminds me, so as part of our unit, we work with a lot of cannabis entrepreneurs, and I think what you're sharing is what we see a lot of in terms of pitfalls, so thank you for sharing. So for grant funding, some pitfalls there, I would say with any grant, whether or not it's city or state funding or a private corporation who's giving out grants because they want to show they love the ecosystem of the startup community or small businesses in Boston, and want to show that in a financial way, there will always be reporting requirements. So save your invoices, save any documents that show how you used that funding, because as I mentioned, there is small print for any grant funding, especially in city and state government. And if you do not have the documents required, there is something in there that says we can ask for the money back. It might be a percentage, it might be the whole thing. I would read at the bottom of the application, save everything, because if you don't, it won't look good and you may not be eligible for the next round if there was one. So you want to stay in good standing with the city, with any municipality that you live in if you apply for a city or state grant. I'm trying to think of anything else. Don't spend, there is usually a period of time when you get the grant that you must spend the money too. So you want to have a plan for spending that money before you apply for it. And I would say the biggest mistake I see when people apply for grants, whether they're a nonprofit or a small business or a startup, is trying to fit within what the grant is asking for versus the other way around, which it should be. So for example, with the space grant program, it was fill vacant storefronts with small businesses that were disproportionately impacted by the pandemic. We were getting inquiries like, hey, I've always wanted to start a candy company, so I'm gonna apply for this grant. And the response is, well, you didn't have this candy company during the pandemic, and you can't just start a company because there's free money on the table. So you wanna make sure that what you're applying for is a good fit for your startup and a good fit for your business, so that it's not you trying to get money that's not really a good fit for what you're looking for. Trying to fit into your circle and trying to fit in a square box, basically. And that's, I would say those are the pitfalls.
Yeah, excellent. David?
I just want to piggyback on what you said. So I work with a lot of engineers, and they're very creative. They like shiny things and they want, what's the next thing? And that's great. But when you're building your company around an idea and maybe you're applying for a grant that's right in line with the technology that you're developing, that's fantastic. That fits with your mission. But it can be difficult if you're just chasing grant to grant to grant and never really commercializing your technology. And so like you said, you want to make sure that if you're going for a grant, does it make sense for you now and where you want to go? Because you don't want to get stuck in a trap where you need that grant money because you don't really have a market for what you're doing. Maybe it's new technology, maybe it's really interesting, but is that really what your company should be doing? That's definitely a risk that I've seen. When it comes to banking, what should you avoid? A lot of it goes down to your partners. So not only should you have a good attorney with you, and I understand you don't have a lot of money in the beginning and you don't want to spend the money, you're going to spend a lot more money on an attorney if you do it reactively and there's a problem. So it's a good investment. Same thing, having a good CPA and a bookkeeper. And again, you can, for a bookkeeping, it can be part-time, you're not ready for a full-time, but you want to have someone who keeps accurate records because that's your credibility. When banks look at your financials, if they don't trust those financials, they see that your annual rent moves around like you're just trying to make the numbers work. That's not a good look. So you want to make sure that you're keeping accurate records and you want to be honest. We have to go by what's stated. So we'll look at your tax returns. No one wants to pay more taxes than they need to, but it's okay to pay some taxes because you're profitable. If you say, hey, I really made more than that, it's just like, that's great. I have to go by what's on your tax returns. If you're willing to lie to the US government, why should I lend you money? I mean, you want to make sure that you're on the up and up with that, and you're very clear about what's happening in your business, what your costs are, and not, you don't want to have anything look like you're playing games with the money. So having the right partners and doing the right up front, also having credible financials, yeah, there's going to be some money with that, working with maybe having compile work with the CPA, but that's going to help you. Let's say you've done your bank financing, but now you're ready to buy another company. You're going to need more money at the bank, or there's more of an equity financing opportunity. That's not the time to think, gee, are my finances in order? You're going to have a hard time lining that stuff up. So you want to think, ahead of time, do I have the right partners? Do I have the right level of financial reporting and right level of control? That's going to help you not just run your company and be successful, but it's going to help in bank finance. It's going to help in equity financing as well. So I think in terms of pitfalls, make sure you have the right partners in the beginning. And then we also have rules with our money. We call them covenants. We don't just give you the money that you need to pay us back and here's your monthly payment. We're going to have things like a debt service coverage ratio. So for every dollar of debt that you have from us, we're going to want you to generate, $1.25 of extra cash flow. So there's a little bit of a cushion there. In the beginning, you might not be cash flow positive. You don't want to take on a loan where you have principal interest payments that you're not going to be able to make right in the beginning. But if you work with the right bank, you can have it structured where maybe you're doing interest only that first year while you get up to speed. That's going to keep your debt expenses down significantly that first year. And once you've kind of reached that pivot point where you're running and you're hopefully reach that profitability, you're all set. So make sure that the structure is right, the vehicle is right, the bank is the right one, and your team is right. I think you do that, that's really easy. You'll be fine.
I'm afraid I'm going to have to piggyback on something that David said. I'd be remiss if I didn't. So what happens very often in my firm is we get these books from founders that are doing it themselves, and they're an absolute just horrible mess. I mean, if they didn't come to us and went to an investor first, which does happen often, there's no way that the investor would go through with the investment. So what happens in the process is the investor will offer a term sheet where they offer all the terms to give you an investment. Then they go through a due diligence process. If they sniff any bit of a mess, it's going to cause a big problem for a startup. So very, very important to have really, really clean books and do all of that the right way. Now, I often tell people that you should do the bookkeeping yourself. I know there's a little bit of a contradiction there, but it's really important to understand the basics of bookkeeping. And I mean, most startup founders don't. So they kind of get lost and they abdicate the whole function. And then they're just lost through the rest of the time. So it's great to learn about the books and get somebody to guide you if you can. But eventually, before you start down any of these paths, talk to a professional and make sure that it's all being done absolutely right. Okay, so let's see if we can take like one or two questions from the audience. Does anybody here have a question? Please.
Can you go through the convertible notes and the different types that you're referring to?
Can you go through the convertible notes and the different types?
I can. So in early stages, usually if you're before Series A or usually before Series A, you're not going to do what's called a priced round where you would get a term sheet. Instead, you're going to offer some terms to the investors, and you're usually going to use either a convertible note or a SAFE. So a convertible note, the biggest difference is a convertible note has a maturity date and it carries interest with it, kind of like a loan, right? You can think about a convertible note like a loan, where it is accruing interest and the investor is within their rights to call the note if it matures. So it's a very common vehicle, and it is kind of the traditional vehicle, especially on the East Coast. A lot of investors are just used to convertible notes because it predated a safe. That was a newer invention that came out of Y Combinator. But you really have to know when does it mature, and you have to stay in front of it, right? I've run into that at my last company. You learn a lot when you do your first company, right? So like we did have a note that matured, and I really had to work with that investor because it can bankrupt your company. If it gets to that point and they want to call it with the interest, it can be your whole bank account. And then you're in a pretty sticky situation. So that's the biggest thing with a note to be aware of. The safe functions very much the same, but it doesn't mature and it doesn't accrue interest. So it's a agreement for future equity, a simple agreement for future equity, and it doesn't carry those things. It's meant to be more founder friendly, right? It came out of an accelerator, and you don't have those worries. Not that either one you should just take frivolously, right? Like there's a lot of implications for taking either, but that's the biggest difference between the two.
And they just turn into equity at the conversion, at the next round.
Yes, that's what happens in principle with them. There's two kind of big levers or things within them to know. One is a cap. It's kind of a placeholder for evaluation, right? Because you can't have a valuation unless you're pricing what a share of your company is worth. That's the reason you don't do it in the early rounds and why notes and safes exist, because when you're so early, there isn't really any value to place on a share. So you're going to have a super ridiculous low valuation if you went out to do that, which is in nobody's interest. So you say, okay, let's put a pin in that. We're going to cap what the valuation can be when it gets to the price round. So that's where, you hear, well, you have either a pre-money or a post-money cap. I'm happy to answer questions after. You're going to dig into all of that right now. But you're saying, hey, when I do a priced round, even if we go gangbusters and I have a huge valuation, you, early investor who's taking a risk on me now, you're not going to have a valuation that's more than this amount, right? And when you're early, it's usually somewhere between like 3 to 10 or, somewhere in that range, depending on what your business is. There's kind of an art to it. But you're capping it for them to, say thank you for being an early investor. And there's a discount as well. So you can, it's one or the other, usually that triggers based on whatever that price round ends up being. So you can say, hey, also when we do a price round, thank you early investor, you're gonna get a discount on price per share compared to who's coming in later because you took the early risk. So those are kind of the mechanics of it. And then when you do get big enough and valuable enough, you're gonna price your shares. That's when they convert and they actually own equity in your company, but they don't own it until that happens.
Great. We've got about 5 minutes left, so let's see if we can get one more question. Does anybody have a question with regards to non-dilutive or debt funding? Any non-dilutive or debt funding questions? Please.
What's the state of like SBA related grants or loans?
The question is, what is the state of SBA related grants?
I think that's a combo that we can maybe both answer. SBA typically gives out loans, not grants. I will say that, but on the city end, we work closely with the SBA when it comes to supporting businesses by spending money on services that can help. So technical assistance like marketing, legal support, et cetera, in a way that is kind of like grant funding because you're benefiting from those services that we or the SBA is paying for. So we're always happy to connect you with them, but I'll let you talk about loans.
So the SBA has a variety of loan programs where they'll do a guarantee. So one thing is your business SBA eligible? So that's one thing to look at. Another thing to think about is, so there are banks that will do SBA. You can either go straight to the SBA and they'll direct you to a bank. There is what's called preferred lenders. So banks that are preferred SBA lenders are underwriting the SBA loans themselves. So they're not sending it out to the SBA to be underwritten. It's a faster process. And I think you're gonna be better off if you're working with a preferred lender when it comes to an SBA. Another important thing to think about with the SBA is just because something is allowed or permissible within the SBA program, doesn't mean all banks are gonna treat it the same way. So within the SBA loan guarantee program, banks will kind of think, okay, we can use, we can go out X, Y, or Z, but we're not really comfortable, so we're not gonna do that. Whereas another SBA preferred lender might say, you know what, we'll green light this. To give you an example, prior to M&T, I was with People's United, and we had an entrepreneur, and he just purchased three location franchise. And so he came to People's, where he had his personal account, and say, hey, this is an SBA approved franchise. I have my personal accounts with you. I want to, talk to you about SBA financing. And he was told, although that's an SBA sanctioned franchise, and you can finance early stage companies like that with the SBA, we're not really doing that. We're looking for at least 2 years of experience. So he had to go elsewhere. I was introduced to him this summer, right after we did the whole fund conversion. And I was talking to him, and he said, oh yeah, I really want to go with you guys, but you won't work with early stage companies in the SBA, so I had to go to this other bank. But I saw this third location. I go, well, let's talk about that, because M&T will finance startups with the SBA. So, the bank you're talking to, appetites change, things change. So what's okay by the SBA is not necessarily going to be the same for every bank, or the same in any bank, year to year. So again, you can check out, who is a preferred lender. You can see, the outline of the programs, but how does a bank apply that? What is your appetite? You're gonna need to talk to the bank. And that's when you reach out to a bank, ask, so here's my question, who should I talk to about this? Because that's also very important. You can talk to very helpful, nice people, but if they're not the right person, it's not really going to matter in the long run. You want to be able to get to the right person. If you're working with the right bank, they'll know who that person is, they'll understand the question, they'll get to the person quickly. If you're working with the wrong bank, you might get an answer, might not be the right one, you might get lucky.
Excellent. Thank you very much. So that's it for our time tonight. Thank you very much for coming. I'm going to pass this over to Emily.